Lumber, gold, copper. What do these things have to do with the stock market? We discuss that and more in Intermarket Analysis, a part of Research by Potomac.
Okay, everyone, welcome back to another episode of Who Charted, the most exciting 6 minutes in markets. We are fresh from our company retreat in Denver, where the all-star team of Who Charted, myself and Drew Wells, who's here with me, I had a chance to meet for the first time in person. Very good weekend, but now back to business. 6 charts, 6 minutes. Drew, you know the drill.
Absolutely. So we have the S&P 500 here, and top pane, the percentage of components highly correlated with the index in the bottom pane here. This is a chart I think that you've seen us cover for a while now. Correlations in and of themselves really aren't that great of a signal until you actually combine them with something else. But I want to highlight a couple things here. Number one, we're at the highest reading all year long, not only all year long, but levels that we've not seen since the summer of 2020. So, I think I like to use this chart in particular in a former life when I manage money. It gives you a good idea on where to focus your time, right? Because a lot of questions, whether it's from money managers or analysts or whatever, how do I know where to spend most of my time focusing on the chart of the asset versus the market? Right now, you want to pay a lot of attention to the market because that price action is bleeding down to the individual stock level to a pretty high degree.
All right, paying attention to the market, we recognize here that a lot of investors have no choice but to be invested in an asset class. In this case, the asset class being U.S. equities. And for the past couple of months in our work, we've been highlighting the fact that the name of the game right now is to focus on relative strength. And what that really means, essentially, in the U.S. equity market is finding what's less bad. A couple of weeks ago, we wrote a note that was titled, "Would you be surprised?" And it was a deep dive on, would you be surprised if small caps were outperforming? Well, here's the S&P 600 weekly chart. In the top of the panel there, just not something you want to look at. Below key moving averages, breaking down. However, look at the relative chart. Relative to the S&P 500 at the bottom there, starting to poke its head above first resistance. Now, if we can get above the October, November peaks, that's that dashed line, you can start making the case that small caps are leadership. Now, right now, leadership simply means down less than the S&P 500, but it's something we're focused closely on right now.
All right, everybody's been watching the chart of copper for good reason, right? Copper is the one of the most cyclical, heavily used industrial metals out there. From an economic perspective, we're not economists, but as Dan's mentioned before, it kind of allows us to play that a little bit. Take a look at the price action in copper throughout this month, right? Tested support level right around $4, has rallied up to resistance right there at 433. Roughly below a 50-day moving average, though, now declining 50-day moving average, kind of chopping around in that range a little bit. But one of the interesting things is we can take a look at relative performance of stocks, of copper mining stocks, to give us a good idea of where copper might go, right? So the relative performance has recovered that resistance area right above the 50-day moving average ratio, which is declining. So this is some bullish price action coming out of copper miners, certainly on a relative basis. We certainly like to see some follow through on copper to get a little bit more bullish on risk assets, though.
All right, sticking with that small cap theme, here's a chart in the top panel, 2020 to present, of small caps relative to large caps. And you can see after bottoming out with the COVID lows, small caps went on to outperform large caps. Then they peaked and had a pullback. And now they are starting, as I said, as we alluded to earlier on the previous chart, starting to outperform once again. So you can kind of see I have that question mark there all the way to the right-hand side of the chart. And what's interesting is there's actually precedent for this. Now, this is not an analog chart. I do not do analog charts. But, in a risk-off type environment, some people are surprised when we highlight the fact that small caps are performing better relatively. But if you look, the exact same thing happened following coming out of the lows in 2000, right? Market topped in 2000. Small cap relative strength started to rally. Then there was a pullback, and then there was a hard rally once again. So that's kind of a roadmap that I think investors can keep in mind as they're looking for relative strength within the marketplace.
Again, big theme here is relative strength. We've been highlighting the few pockets to hide out, kind of in the storm, and really that's been the strategy for the last several months or so. I think it surprised a lot of people to see that a lot of the dividend themes were performing really well, right? So not a great look for dividend growth. ETF here, DGRO on the top pane is a test resistance right around the $49 level. But take a look at relative performance to the S&P 500, right? Broke out in early May, again, just kind of retesting that highlighted support zone. Rising 50-day moving average of the ratio. This market has not given a lot of people a lot of places to hide out in. The dividend theme has been one that's been kind of, I would argue, left for dead for quite a while. When you bring that up to people who look at markets a lot, you know that it's been a while since you've seen dividend stocks outperform. So this is one we're watching closely, particularly to see if that $49 resistance level gets captured to the upside.
All right, final chart that kind of focuses on the theme of trying to see what's less bad, international versus U.S. Now, this has been a disaster of a theme for more than a decade. And this is not a call that it's changing right here on the spot, but it is kind of interesting that if we look at the ACWI ex-US ETF, ACWX, relative to the IWV, kind of a big picture US equities, we are on the verge of a breakout on that relative trend. And then the 6-month rate of change has gone positive. Now, we've seen this movie before. Right, I think it's something that we want to be keeping an eye on, right? Similar to what's happening with the small caps, is that there is some improvement happening under the surface here on a relative basis. And if that, wouldn't take much to kind of shift these trends. So it's something that we want to keep an eye on as we are now, keenly focused on what's least bad within the equity landscape. So those are my 3 charts for this week. And Drew, bring us home.
Thank you so much for spending some time with us, everybody. We have survived and thrived on our company retreat. We're so excited to be back with you. If you like this content, please like and subscribe, and we'll catch you next time.
Thanks, everyone.